Unlike most examples so far, FSLR doesn't see levels from the IPO day candle immediately used, as an uptrend gradually accelerates into a steep incline almost right from the start of trading on the market. A series of distinctly bearish candles has formed a less strict triple top to define firm resistance in the low 300s at new record highs. This sends the chart into a neutral to bearish phase rather than a major drop due to selling volume decreasing by early June. Resistance centering on 292 leads to what can be considered a less strict triple top in the short term, but more accurately the upper boundary in a horizontal resting phase of a downward continuation. Note, volume is generally low in the flat trading range from June to late August, and there is high volume with steep declines in price before and after this mostly horizontal range. It is just like a 3 methods falling but on a much larger scale. Within the large downtrend, there is a good example where a gap up level becomes even more significant as it reverses roles from support to resistance. The mid-170s area also encompasses a descending triangle, compact double top, and gap down combination from May to August. Again, here is a case where a descending triangle appears at the top of a small uptrend to reverse back down. Technically, downswings after the early May peak form the downtrend line. However, a less strict interpretation sees the overall downtrend line can be extended to encompass a larger triangle outline for the descending triangle to act in the capacity of a reversal and a bearish continuation. This again is a minor detail due to discrepancy between ideal theoretical criteria and volatile price action that naturally occurs on charts, similar to the minor detail of some triple tops and head and shoulders reversals having common features. The important thing is the patterns provide clear sentiment and reference markings. In this case, chart patterns mark bearish sentiment progressively increasing around the 175.50 area. Since there are some sharp bullish retracements, a downtrend line from the descending triangle is not useful. A raised trend line onto the high of the compact double top is more accurate in identifying the approximate bearish reversals towards October. This comprises a flat double top range that develops from the natural neutral to bearish price action that can take place after a downtrend line is crossed. As usual, the trend lines are helpful but tend to diminish in influence over time after being crossed. All the patterns in 2009 contributed greatly to maintaining the strong bearish climate. Eventually, the range around the IPO price becomes highly relevant, as even it is breached to serve as a reminder that what goes up must come down, and nothing lasts forever. That is not to say all stocks, even those with an aggressive uptrend after the IPO, will eventually crash back and even reach new record lows. Rather, it is a reminder that change does happen in the markets, even if it seems like a trend has lasted forever. This applies to both up and down trends as seen here. A great example where the IPO price range highlights contention and role reversal, as it first presented heavy resistance as part of an ascending triangle's resistance range, and later gap down range that encountered expected strong support to create a triple bottom, with a slight incline due to the second and third upswings being higher than the first upswing. After leaving the 20s, the IPO range still holds great importance. In the event there is another large-scale decline. More recently, the market has moved into a flat range with neutral to bearish sentiment. Notice how, like in most patterns, there is often a short period of low activity prior to the range forming. In this case, there is almost a full week of relatively low volume and unchanged price, from early to mid-May around 50.50, prior to the formation of clear swing points forming a range. This can be a common occurrence and is more of a tertiary observation, rather than a primary or secondary consideration in chart pattern analysis. It is a small detail highlighting short-term indecision prior to the formation of chart patterns. Such low activity price action can also be observed around the time of a pattern's completion when a pattern is delayed. In this case, there was a swift triple top with almost perfect price action displaying sharp swing points in a relatively short period of time. Closing prices are also generally neatly contained within the range defined by price levels at round numbers. If there was no overwhelming bearish volume and strong price action with large red candles, there could have been some low activity price action upon returning to 50.50, similar to the week of flat trading in early to mid-May discussed earlier. As usual, it is not out of the ordinary to have a retracement back to the breakout area that completed a pattern. In this case, a minor upswing back to the 50.50 area where the triple top completed. Although it was a fairly strict triple top with a mainly horizontal range in terms of closing prices, there is a slight decline presented with a trend line drawn from the absolute highs of the first and third downswing points. A trend line drawn this way from relatively flat patterns can still be useful. It is similar to how downtrend lines from declined double tops and triple tops can be used to identify areas of potentially stronger resistance. These areas of stronger resistance potential are from downtrend lines intersecting with resistance ranges. In this case, it was very similar to a head and shoulders where downtrend lines from the triple top range mark the approximate area in price and time where the minor July upswing would encounter stronger resistance for the likely resumption of longer-term bearish sentiment. It was very normal, like in many other examples, to see slight resistance later in early October, when a stronger uptrend decisively surpassed the downtrend line after a temporary delay. Strong resistance is encountered upon recontacting the triple top range, despite a bullish spike in late October. In the final week of October, resistance remains firm, but not too strong. This allows for a minor downswing to be largely contained within the old triple top range prior to general three methods rising price action fully developing to continue the aggressive uptrend into November. Naturally, the old triple top range becomes useful once again as it is the focal point of the gap up fill and further bullish continuation in early 2014. Later, the uptrend ends with a flat top that forms from several swing points after the first sharp downtrend from a more strict double top variant. On the way back down under 50.50, there is a fairly routine gap fill with extraordinarily high volume in the short term, as the upswing in the gap fill region formed by general morning star price action consisting of large candles. There is some influence from the declined triple top from early 2015 at work, as the lowest point on August 24th does dip into the major support range in the 40 to 41 area. Despite the volatility, closing prices are mainly within the broader 40 to 50.50 range, to highlight the more significant influence of past patterns. 50.50 is an example of an extremely precise price level persisting despite the passage of time. Note how even years after its identification as a key price level, it still has candles form real bodies that consistently come close to opening and closing exactly at 50.50. As seen in other examples, FSLR provides a great reminder to watch price action closely, especially before an earnings report that saw the common characteristic of low activity prior to a gap. Even though 50.50 was a strong resistance and short-term price action was neutral to bearish, it was not a certain downtrend in development. This is due to the unpredictable market reaction that would almost inevitably take place around the earnings report. Interestingly, the last major descending trend line still had some influence on downswing formations. As well, the range around the IPO presented strong support potential in early 2017. This was due to no fine adjustment taking place. In fact, the highest level near the IPO at 25.18 wasn't even contacted directly. To take into account wider influence from price action in 2012 and 2013. The 50s range was comparatively low maintenance as it was the site of clear price action and major patterns on a regular basis, which is why no adjustments needed to be made even after so many years.